Hello, and welcome to Portfolio Matters. In today's podcast, we will be discussing the return of the Eurozone crisis, which seems to be coming back remarkably quickly. So this will be quite a long discussion of the origins of the Eurozone crisis and the potential consequences. And Richard, Stuart, and I will have a round table discussion at the end. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests you may have on the show are entirely their own and may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
Okay, thank you, Richard. Well, the Euro crisis is back. So remember this. This was back between 2009 and 2014 when there was an enormous crisis in Eurozone in the periphery. And you see that Greek bond yields, which are the dark orange line, hit over 25%. And there was a general liquidity crisis that hit all of the peripheral nations. So Portuguese bond yields were over 10%. Italian bond yields approached 10%. And this was finally solved by Mario Draghi committing the ECB to doing whatever it takes to solve the crisis. Well, it's back. In recent weeks, in fact, in recent days, you've seen a very sharp acceleration in Greek and Italian bond yields. And as regular viewers of the weekly will know, during the COVID crisis, both Greece and Italy, in fact, pretty much every nation in the world, increased their debt burden quite substantially. And so all nations are increasingly sensitive to rises in interest rates. And if Greek and Italian bond yields continue on their current trajectory, we could have a solvency as well as a liquidity crisis quite quickly. And this chart is from today, and it shows accelerating sell-offs in the bond yields of periphery nations. Now, this is a very poor chart, and it's got lots of different scales, but you get the impression of rising bond yields across Greece, which is orange, Spain, which is blue, Portugal, which is purple, and I can't see what the last one is anyway. So going back to the origins of this crisis, which are in the original format of the Eurozone, the way it was set up. And it was well known that when the Euro was instigated, that the Eurozone was not an optimal currency area. Now, what constitutes an optimal currency area? Well, you should have high labor mobility, so workers should be able to move between regions quite quickly to arbitrage price differentials, wage differentials between regions. If you think of the US and UK, you can easily move between different areas of the country if the wages are better there. Unfortunately, in Europe, obviously, there are linguistic barriers to moving between, let's say, Portugal and Germany, as well as cultural ones. Second, you should have capital mobility and wage and price flexibility. Now, you do have those to a decent extent. So in theory, capital should be able to move between high-cost Germany to low-cost Portugal to set up a factory there to produce the same goods, although there are, of course, some cultural and other barriers to actually doing so in practice. There should also be a fiscal rebalancing mechanism between regions. So when one region of the optimal currency area is doing badly and was in recession, when the rest of the currency area is doing okay, there should be either explicit or implicit fiscal transfers to aid the region in difficulty. Now, in the US or the UK, that is automatic, and it happens via welfare payments and reduced flows in taxes from regions that are doing badly towards the center. Now, I was recently listening to a podcast by Paul Krugman on the original Eurozone crisis, and he was saying how in the US, if you looked at Florida, there were actually very substantial stimulus to the Florida economy, which he compared to Spain, when it had problems, because there were increased welfare payments in the form of unemployment benefit to people in Florida who had lost their jobs. And also there were reduced tax payments from Florida to the central government. And that constituted a very large fiscal stimulus from the central government to Florida. And he was saying that in the US, that happened implicitly, whereas in the Eurozone, that had to happen with a law that was passed. They should have similar business cycles. So monetary policy, which is set from one source in an optimal currency area, should be appropriate for all regions at the same time. Obviously, you don't want some regions in recession and needing low interest rates and other areas doing very well and needing high interest rates. And the Euro area has lots of different countries which have different cycles, in particular, the Southern European nations, which have lots of tourism, and the Northern Europeans, which are more industrial, although they will share similar business cycles, but they will be slightly out of sync. There should be a high volume of trade between regions, which imposes homogeneity in prices and other things between them. Now, the EU does pass that test. Finally, and crucially, an optimal currency area should have homogeneous policy preferences. So all countries should agree on whether to raise taxes, raise interest rates, or other general economic policies, and that is crucial. The EU fails very badly on that test. Now, if we go through the checklist of those criteria and see if the Eurozone meets them, well, it fails on a number of points, particularly high labor mobility, but above all on homogeneous policy preferences. And we dig into that background a bit further, I would split the Eurozone into two distinct areas. I would split it into the Northern European area, whose economic model is based on societies which have high levels of social cohesion and adherence to social norms, high levels of trust in government, low levels of corruption, and high levels of tax payment and tax adherence. And as a result, governments can fully tax the populace to pay for their expenditure, and they run balanced budgets because the populace tends to pay the taxes. Whereas in Southern Europe, you have lower levels of social cohesion and adherence to social norms, lower levels of trust in government, higher levels of corruption, and lower levels of tax payment, higher levels of tax avoidance. And that means governments are unable to fully tax the populace to pay for their expenditure. And what they do is they run persistent budget deficits, and then they have higher inflation, which is a hidden tax with which to balance the books. Now, both social models are entirely valid. And I'd say the UK comes somewhere between the two, frankly. But the Eurozone essentially attempted to force the Southern Europeans to abandon their traditional model and adopt the Northern European one. And I would trace the origins of the Southern European economic model back to the Middle Ages. And this is a chart of the Islamic world in 1000 AD. You see Spain, Southern Italy, including the whole of Sicily and the southern tip of Italy were all under Islamic rule, as was Greece. And economists who have done the work on this trace the period under which the Southern European countries were under Islamic rule is directly related to the level of corruption. Essentially, these nations were subjugated by Islamic rulers who did not share their religion, and they saw the government as illegitimate and did their best to avoid it and avoid paying taxes. And that culture has persisted. The point of that is that the culture has persisted for 1,000 years. The euro has persisted for 20. And the idea that the euro was going to change the Southern European culture to a Northern European one very quickly, I think, is misguided. So the Eurozone fails the test as an optimal currency area. Stuart and Richard, any thoughts?
Well, I think that cultural point is very important. I had no idea that you could sort of draw some origin back to the time of Muslim control, but I was thinking just more short term, that if you don't have a sort of binding history and culture between peoples, it's going to be difficult to, for instance, accept fiscal transfers. We see this with caricatures, German caricatures of lazy Italians or vice versa. And that just provides the wrong political background to make decisions which will be acceptable. It's inevitably going to cause tensions and finger pointing.
Yes, well, absolutely. It's homogenous policy preferences. I mean, essentially, they're not one people and they don't feel it.
Yeah, I'm also struck by the first bullet point, oppressive rule under a different religion. And in the first Euro crisis, the Southern European nations which were over indebted had oppressive rule by the ECB in terms of the requirements that were stipulated in order that they should bail them out. So in fact, rather than trying to normalize and integrate it, they may have actually pushed them further away by pushing them under these what were in fact really quite oppressive rules in terms for their bailouts.
So I would just also say, Richard, that, and we'll get into this in a second, that the level of compliance with the ECB by Greece was absolutely extraordinary. Ultimately, Greece decided it wished to stay in the Eurozone, and the amount of austerity that it accepted, although it grumbled like hell, it did the work. When you look at the fall in GDP, I find it amazing they actually complied.
Keith, one other observation. I wonder whether now we're having the inverse effect, where all the money printing and the buying of the sovereign bonds is something which would be acceptable in one culture but not in another, and you're going to cause a sort of resentment the other way around. So everyone is going to have had a period of being frustrated and annoyed with the arrangements. I
think that's true. I should say that in preparing this presentation, I reached out to two of our Discord members, including one of our German followers, and I was struck by how skeptical he was of the whole Eurozone project. And that is something I have heard from quite a few of my German friends, actually, that they resent having to subsidize the Southern Europeans. Okay, on to the Eurozone rules. And when countries joined the Eurozone, they had to agree to obey certain fiscal rules so that the Eurozone was then fiscally homogenous and monetary homogenous, so that the one interest rate set by the ECB should suit them all. And the Stability and Growth Pact set the rules, and that was the state's budget deficit should not exceed 3% of GDP in any year, and the national debt should not surpass 60% of GDP. Now, what were the penalties for failure? Well, failure to abide by the rules for 3 years in succession would lead to a maximum fine of 0.5% of GDP. Now, there's a subsequent 2012 Treaty on Stability, Coordination and Governance, and that clarified the Stability and Growth Pact further. And it said a general budget deficit should not exceed 3%. And for countries with a debt to GDP ratio above 60%, the structural deficit should not exceed 0.5%. But if we look at the latest data from Eurostat, we can see that practically half the nations, over half the nations in the Eurozone, fail to meet the 60% of debt to GDP. Greece, and this is after the restructuring, has debt of over 200% of GDP, Italy above 150%, Portugal and Spain close to 125, France over 120%. The euro as an area as a whole is approaching 100%. So nobody is obeying the Stability and Growth Pact. And if we look at the fiscal deficits, and this is the latest data for 2021, projections from Eurostat, then at the bottom is Malta, followed by Italy, with deficits of minus 12%. Bear in mind that the rules say minus 3%. Greece minus 10, Latvia, France, Czech Republic minus 10. Essentially, only Denmark and Luxembourg actually have fiscal deficits within the rules. And the fundamental problem is that the Eurozone was designed with enforcement procedures that are just not credible. If a country is having difficulties balancing its budget, then attempting to fine it or withdraw EU funds will only make its fiscal problems worse. And essentially, it can't be done. Okay, so if we return to the first Eurozone crisis, which was 2009 to 2014, and these are the bond yields during the first crisis. See, Greece was the biggest problem. And this was a solvency in crisis in Greece, which became a liquidity crisis for the whole Eurozone. So I'm not going to read all this out, but if you're interested, pause and take a look. Essentially, it all started during the financial crisis when the Greek government, the new Greek government, revealed that the old Greek government had been lying about the deficit. The old Greek government said they had a deficit of 6.7%. The new Greek government fessed up and said it was actually 12.9%. And then cue international bond rating agencies downgrading Greek debt and everyone fleeing. The yield on Greek debt went through the roof, and that meant a solvency crisis. So the EU then tried to implement a new fiscal plan to cut their deficit to below 3% within 2 years, but actually they couldn't do it. And very quickly they were threatening to leave the Eurozone. At that point, the IMF and the EU became involved with 240 billion in emergency loans. And the bailout was in return for austerity. Then in 2012, and bear in mind, during this whole period, there was contagion to the rest of the periphery. Remember the acronym PIGS, P-I-I-G-S, Portugal, Italy, Ireland, Greece, and Spain all had very elevated bond yields. But then the crucial moment was when economists in the EU actually realized that for most of the peripheral nations, such as Italy and Ireland, their fiscal deficits weren't that much worse than Germany or France. And actually, they were facing a liquidity crisis rather than a solvency crisis. And Mario Draghi promised to do whatever it takes, i.e. unlimited bond purchases. And actually, he didn't have to do anything, but just the words were enough to restore market confidence and solve the crisis for all the countries apart from Greece. But then in 2015, after years of austerity, Greece elected a new socialist prime minister, Alexis Tsipras, with a mandate to fight austerity. And in June of that year, they missed a bond payment. So they were then on course for default, with all the consequences that could ensue, and that could mean falling out of the euro, and we'll get into that in a minute. And they then had a referendum on austerity in which the Greek people basically voted against austerity and gave the government the mandate to leave the Eurozone. But when push came to shove, the socialist government fired Yanis Varoufakis, who wanted to leave the Eurozone, and implemented austerity. And if you look at the amount of austerity the Greeks had to endure, you'll see they had negative growth throughout the period from 2008 to 2014. And if you look at their GDP, the cumulative results are absolutely shocking. From peak to trough, they had a 45% fall in GDP over 11 years. So, in summary, the last crisis was solved through actually an extraordinary commitment by both sides for Greece to remain in the Eurozone. Greece endured 11 years of austerity, and the EU stumped up the best part of 300 billion. Bond yields are spiking again. So the fundamental problem is the euro is always a political problem, not an economic one. And you've stuck together lots of countries with very different cultures. And explicit in the original agreement was that there were to be no fiscal transfers. So one of the key components of an optimal currency area was explicitly ruled out. And now Greece and Italy both have enormous debts, well in excess of 60% of GDP, in fact, well in excess of 120% of GDP, and the running budget deficits were in excess of the 3% limit, as you've seen, actually 12% for Italy, 10% for Greece this year. So if bond yields rise and they have to pay more interest on their debt, their budget deficits can only get worse. And the bond market is realizing this, and investors are starting to flee. Now, if there was a crisis in a country outside the Eurozone, how would it be dealt with? Well, the exchange rate would naturally adjust lower, which would help the balance of payments. And you would have a bond restructuring with the IMF. So creditors would take a haircut and the exchange rate would fall potentially quite a long way until you had a cut in imports and growth in exports due to cheap labor, and the economy should then be self-normalizing.
In a sense, Keith, that's sort of what happened with the gold standard in the 30s. That you could make an analogy between the gold standard and the euro. That fixed arrangement. And your only way out, if you're, say, France in the 20s and early 30s, is get off gold. And similarly, that should be the solution for countries in a similar position within the euro. But the political commitment remains very strong.
Yes, absolutely. Now, one of the fundamental problems with the Eurozone, and I'm glad that Stuart's brought up the analogy of the gold standard, is that you can't, because your exchange rate is fixed and your monetary policy is set by the ECB and you're constrained by the Growth and Stability Pact, you have no legitimate way of stimulating your economy. You can't increase the budget deficit beyond 3%. You can't lower exchange rate. You can't lower interest rates below that set of the ECB. So the periphery nations, if they're suffering economically, are trapped. The only way to stimulate the economy would be to cut wages and profits in the real economy, undergo austerity.
But that doesn't, with respect, that doesn't stimulate the economy, does it? That
Precisely. That's right.
So there is no way to stimulate the economy.
Absolutely. So within the Eurozone, how can we solve a solvency crisis? Well, either have to have explicit transfers, which would require a change in EU law. So the fiscally conservative northern countries would have to agree to fiscal transfers to southern European countries. You'd have debt write-offs, but then who takes the write-off? In the case of Greece, most of the money is held by the ECB and EU financial institutions, which were in turn funded by German banks. And also, that's possible for Greece because it's only 3% of Eurozone GDP. It's just not possible for Italy. Italy is too big. It's got too much debt. It's now the second most indebted country behind Japan in terms of debt to GDP. Or you could continue with bond purchases of the periphery, which would put a cap on their interest rates and essentially subsidize their bonds. So stop the bond yields rising too much. But that implies continued purchases of bonds in the periphery by the ECB. Where do they get the money from? And when you're raising interest rates, you're there, on the one hand, you're then buying bonds using what money?
We can summarize all of these solutions by saying at some point this debt has to be written off, and the holder of the debt, which effectively is to a significant extent the ECB stroke Northern Europe and specifically Germany, take the hit. It doesn't really matter which path they take. The ultimate consequence, I think, is the same.
That is something you're talking about, essentially either a crisis or a debt restructuring. And that is something that everyone wants to avoid because, taking a write down, when that happens,
it's something everyone wants to avoid, but I'm not sure that it is actually avoidable.
I think everyone will try and avoid it for as long as possible.
I'm sure you're right. I'm sure you're right.
Because, and let's go into the effects of a crisis. If bond spreads were allowed to rise, Greek and Italian budget deficits must widen because they're paying more in interest. And because they've got so much more debt, the chance of them defaulting on their bonds will have to increase. Therefore, you get a spiral by which, as spreads widen and investors worry about the solvency of Greece and Italy, they flee the bonds, and that exacerbates the problem. And there's no way of tackling this crisis apart from committing to austerity, which would drive the countries into recession and actually could exacerbate the problem because fiscal revenues could fall.
I think what one aspect here is also banking regulation and the twisting of arms in the banking sector to hold local bonds. So Italian banks hold Italian bonds. So any sort of write down would decimate the banking sector and cause obviously an economic collapse as credit was withdrawn. And I think it's quite interesting how for a supposedly fungible currency across the Eurozone, actually countries' banks are holding wildly disproportionately the debt of their own countries.
It is the issue is that there is a lot of bad debt, and fundamentally this debt is bad, and it doesn't really matter where you stuff it. At some point, the bad debt has to be written off. Whoever's left holding it takes the hit, and if you can't afford systemically to let the person holding it take the hit, it migrates all the way back to Germany. And the problem we have here is that it's getting so large that Germany can't afford it.
That's true, because if we skip forward to the target 2 imbalances, you'll see that within the European banking sector, Germany is by far the biggest creditor, with Luxembourg a distant second. And the debtors are Italy, Spain, the ECB, and Greece.
So just to explain target 2, if I can, because I think it's useful. Germany has effectively exported to the southern European countries, and those exports have been financed by the German banking system. But the German banking system hasn't been paid. So the imports by the southern European countries of German goods are effectively unpaid for. And if it transpires that the southern European countries can't pay, which in a financial crisis they couldn't, German banks are on the hook, and the Luxembourg banks, very significantly large portion of the Luxembourg GDP as well, for that money, which is 1.2 trillion euros.
If we think about the effect of a breakdown of the Eurozone, a crisis, then institutions holding Greek and Italian debt, such as target 2 imbalances, they would suffer huge losses. Essentially, the whole of the German banking system could go bust. You would then have contagion to all the other Euro's periphery nations. If Italy and Greece go bust, then people start taking their money out of Spain and everywhere. And higher bond yields throughout the Eurozone would essentially close the bond market, financial crisis around the world. Any more bids?
Sadly not.
No. So what can we do? What is actually going to happen? The markets, to my mind, the markets are going to force this issue. The markets need to know whether the EU has the political will to tackle this crisis. So that could mean either the EU having to pass explicit fiscal transfers, or the ECB committing to keep peripheral bond yields down. The alternative is crisis. So what do you guys think?
Well, all the logic points towards a crisis. I can't see the political will being there, the social buy-in, for instance, the stories you were telling about your German mates, to allow explicit fiscal transfers. It will just seem so unfair. So I think there'll be an attempt to paper over the cracks for as long as possible, to muddle through. But it seems inevitable. There's the wrenching tensions will cause a crisis.
Richard.
I agree with Stuart. I don't see a way out of this. I think the way out of it was when Mario Draghi mistakenly said, we'll do whatever it takes. And actually, they should have solved the problem at that point. I think by letting it drag on effectively another 2/3 of a decade, it has now got so large that it is uncontainable when it goes. And in my view, it will go.
So hang on, when you say that Mario Draghi should have solved it then, what do you mean?
Well, Greece should have been allowed to leave the European Union, the monetary union, possibly Italy as well, and they should have possibly even been forced out and told to come back when they got their economies aligned with the Eurozone. The situation is much worse now because the debt is much greater. Inevitably, I mean, we have this inflationary situation, which, as we know, is what's causing interest rates to rise, and with inflation forcing the hand of the central banks to raise interest rates, and ultimately interest rates will rise whether the central banks wish them to or not, with inflation as it is, unless they start to impose regulations about how pension funds and so on and so forth, and have to purchase EU government bonds. But even then, ultimately, the problem isn't solved. So I think that the solution has to be a partial breakup of the monetary union.
Well, Richard, I remember during the crisis, I think it was Martin Taylor, the ex-chief exec of Barclays, said that, slightly tongue-in-cheek, but I think it captures the point, he thought there should be a neutrino and a sutrino. Those are the north and the south are the areas which have more commonality and consistency. And you can't deny reality forever. It's been denied by geezers of cash from the ECB, but that appears to be the spigot's being turned off a bit at the moment, and very quickly yields have risen with simply talk of tapering.
So unfortunately, Keith, I'm going to have to go shortly. So just to sort of put my last thoughts on this. I think that there is a way that this problem can be solved, and I will be called a tin-hatted gold bug. But my view is that probably the solution is a reversion to some form of the gold standard in order to stabilize the situation. But the quantity of money printing that would be required to bail this effectively distressed debt out is so vast that I don't think it's feasible. I don't think that the German government ultimately can go there. And I do think that there is a way of stabilizing the situation via moving to a gold standard. And I'm sure that would throw up other problems that need to be solved. But I think some of the European countries do own substantial quantities of gold. The ECB owns gold. Germany, Italy, France all own substantial quantities of gold. So I don't think it's unfeasible.
Yeah, but getting there would involve a crisis.
Yes, undoubtedly. Yeah.
Unfortunately, we've had to lose Richard. So Richard, Stuart, and I will wrap up. Now, both Stuart and Richard are pessimistic about the prospects for a Eurozone crisis. And if that is the case, then they have to also be very pessimistic about the outlook for all risk assets, because a Eurozone crisis would cause an enormous financial crisis around the world. Is that correct, Stuart? So you are basically forecasting an imminent financial crisis.
Oh, Keith, you've pointed out the logic of the situation. I'm not sure I'd thought it through all that way. I'd been thinking, okay, fine, so I need to avoid, in particular, Southern European assets because of the likely depreciation. But what you're saying is thinking through the steps, thinking through the path. It's just going to cascade not just into Northern European assets, but everywhere.
Yep.
And yet I find myself resisting that on the thought, well, what can I invest in then? Cash, gold, places far away.
Actually, you probably can't even invest in gold. You'd have to move back to cash would be your only option. Because if Greece and Italy go, let's say, if they leave the Eurozone, they crash out, and then they would attempt to repay their debts in devalued drachma or Italian lira. Bondholders would get back, 30 cents on the dollar, let's say. You'd have a massive solvency crisis in particularly German banks, but then global banks. And that would be just an enormous financial crisis, essentially. You could see that, runs on the banks, a la Northern Rock, and banks having to pull in their loan books, etc., etc. It would be very bad.
And hence, the answer in the short term would be even more money printing, wouldn't it?
Well, probably it would. That's be the only answer. You'd have to recapitalize the banks. And gold, I don't think, would be a hedge, because whenever there's a financial crisis, people who hold gold have to sell it to meet their other liabilities. And you tend to find that actually gold sells off in the initial period of a crisis. So holding cash would actually be your best option. But I'm going to push back on both you and Richard in that I don't think there will be a crisis. I am very struck reading through and going back through the history of the first Eurozone crisis by the commitment of both Greece and the Eurozone to keep Greece in. I mean, it really was extraordinary. I can't think of another country which would have willingly endured 11 years of austerity and a fall in GDP of 45% cumulatively. So the Eurozone committed, best part of 300 billion in new money and bonds, and Greece in turn underwent extraordinary austerity. And I think both sides are aware of the stakes. If Italy and Greece were to fall out of the Eurozone, then the consequences are almost unimaginable, actually, in terms of financial crisis. It would be absolutely enormous. So let's think about what they can do. What do you think they can do to paper over the cracks and kick the can down the road?
Well, it's just more and more money printing, whilst trying to hope that Mario Draghi, as he's the prime minister, not the president, isn't he? I think of Italy, tries to sort of get the reforms in place. If Italy is the sort of new ground zero likelihood, but it still seems to be so politically fraught that you're asking the Italian population to put up with something which they have consistently said they're not willing to. And we've seen the 5-star movement, we've seen other left-wing solutions as well. But I suppose your point is, well, we saw that in Greece, but actually when they got to the cliff edge, they walked back.
They did, and they actually underwent absolutely extraordinary austerity for many years. And in the case of Italy, again, you have populist movements elected, but when they see the consequences of, provoking a crisis, they step back from the brink. Now, when we think about what the Eurozone could do, I think they will try to put a cap on Italian bond yields and Greek bond yields. So that would involve the ECB buying Greek and Italian bonds. And where would they get the money? That would mean they'd either have to print it, which is difficult to reconcile with raising interest rates, or they would have to sell ECB bonds or Eurozone bonds and use the money to buy the bonds of the periphery and keep the yields down. But
all this being contingent on some sort of grand bargain of structural reform. Yeah.
So, my bet would be that they will kick the can down the road, but I think the markets will force their hand. The markets will push bond yields up until the EU and the ECB are forced to do something.
Well, it's logical, and I certainly hope so. These things often become very, very political, don't they? And that predicting that is.
But if we think through the process, how this is going to work. So Italian and Greek bond yields are selling off. They're selling off quickly. That could very quickly, actually within weeks, lead to a new liquidity crisis for Greece and Italy. And the danger of a Eurozone crisis could then lead to runs on risky assets and a big drawdown in equity markets, and essentially similar fears to the first Eurozone. And those would continue until the EU and the ECB decide to deal with the problem or not. And if not, then we have an enormous crisis.
Yes, you're very good at thinking through the step-by-step, the path dependency and the likely market reaction, not ultimately, but through each phase. And presumably you'll be looking to swoop in after an initial semi-crisis.
Well, I'm concerned about this because I think you've seen the equity markets have had a very good run and there's a lot of potential downside. Now, markets are very complacent about this at the moment, and Greek and Italian bond yields have not yet reached dangerous levels. They're at that 2.5% for the 10-year, which is, not going to cause anyone sleepless nights. But when you get to 5, 6, 10, 15, then if it keeps on going, then that will cause a problem. So I think the best thing to do is watch this space, but be prepared to either hedge your equity positions or move a lot of the portfolio into cash if the Eurozone crisis looks like returning.
And if you are a spivvy punter, are there any instruments for the retail level investor to bet on widening spreads and higher yields? You
would want to buy safe haven assets. So last time, the yields on Swiss bonds went amazingly negative. And you would want to potentially short the euro and buy the spread between Greek and German bonds, for instance, short Greek bonds. But frankly, as a private investor, I think your number one priority is not to lose money, is not to go spivving around in this, high risk stuff. So my concern would actually be increasing the liquidity of the portfolio. So selling down some of the illiquid assets you have in your portfolio and moving to cash or to liquid assets that you can sell very quickly.
Well, that all sounds very prudent of you, Keith.
Well, but Stuart, this is the game I play. Equities are very risky. You want to get out of them when you see something coming.
Yeah.
Okay, a couple of further thoughts before we go. Now, one of the reasons I am optimistic that a crisis can be avoided is that it's much easier to avoid a crisis during an economic upturn when the fiscal pathway is improving, and you can extrapolate that as optimistically as you like. Taxes can be raised when salaries are rising and employment is rising. And in this sort of environment, then some soothing words to calm the nerves of investors may be all that is required from the ECB to soothe the markets and avoid a crisis. And my prime expectation is that the ECB will provide as many soothing words as it can manage. The other point I'd like to make is that Miles44, who on our Discord was talking about how Italy has vast gold reserves and those could be sold to solve the Italian debt crisis. Well, I'm afraid that although Italy has the 4th largest gold reserves in the world, and it's got 2,452 tons of gold, that is only worth 143 billion at current prices, whereas their debts are 2.25 trillion euros or $1.97 trillion. So selling all their gold to the ECB would reduce Italian debt by less than 10%, so it won't solve the crisis. So on that cheery note, I think we are all actually quite concerned. about the prospects for a return of the euro crisis, given how quickly Eurozone bonds have moved. And it is something we will need to keep an eye on in coming weeks. Okay, well, I think that's it. Thank you all for watching. Please can you press like and subscribe to the channel. And it's goodbye from Stuart Owen.
And goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.